Hello, everyone. We put together this quick video to go over the highlights of the recently released IRS Notice 2021-49. It was issued on August the 4th, and we hope it's going to be helpful to let you know kind of where everyone stands with the Employee Retention Credit Guidance. I'm April Walker, a lead manager from the tax section, and with me today is a colleague of mine, Chris Esposito, who is the director of AICPA Tax Policy and Advocacy Team. So let's go ahead and pull up our slides and kind of talk about how we're going to do this. So Chris, emails have been fast and furious over the past week, and right before we were scheduled to record, we got even more IRS guidance. So I appreciate you taking the time to record with me today. This is what we're going to, this is us, and this is what we're going to talk about today. So our plan today is to go through the highlights of the notice, and also we're going to give a broad overview of where we are with outstanding employee retention credit questions and how they've been answered. So Chris's team has really been part of the advocacy efforts to try to get these questions answered. And Chris is going to spend a few minutes as we start off going over the really hot topic of related party wages and the attribution rules. And then I'm going to go over some of the other items that were clarified with the notice, as well as the IRS notice, the IRS revenue procedure that was released today, August the 10th. And then we'll talk about some specific changes that were provided as part of the American Rescue Plan Act. So now I'm going to turn it over to you, Chris, for the somewhat challenging explanation of the related party rules.
Thank you, April. Ever since the credit was created back in the spring of 2020, the AICPA has been at the forefront of requesting guidance and providing the IRS and Treasury with really real-life examples of how we thought the credit should work in certain areas. And we've actually seen quite a few of those examples in subsequent notices, but there were still several important questions that weren't answered until this latest round of guidance was issued. And I honestly don't think some of them would have been answered or clarified without our constant advocacy efforts on those. So let's get into these related individual rules and the issue around whether a majority owner and their spouse's wages, if they qualify for the credit, was the number one outstanding item for our membership related to the ERC. And now we have an answer to share. And the answer is, it depends if they're qualified or not. So let's walk through the rules. So you can go to the next slide. So the CARES Act says that rules similar to Section 51I1 apply, and Section 51 relates to the treatment of wages for the Work Opportunity Tax Credit. And it excludes the wages of certain related parties from the Work Opportunity Tax Credit. And then Section 51I1 also pulls in Sections 152D2 Cap A to H and Sections 267C. So that's where it gets a little difficult, but we're going to walk you through that. Next slide. So what does Section 51I1 say about 152D2 Cap A to H? Well, it basically says wages are not taken into account, and in this case, not considered qualified wages for the credit if an individual has any of the following relationships to either the taxpayer or if the taxpayer is a corporation, to the majority owner of the corporation, or if the taxpayer is a non-corporate entity to the majority owner of the non-corporate entity. So the relationships you want to look at, if wages are paid to employees with any of these following relationships, A through H, to the majority owner, then those wages are automatically kicked out and they're not considered qualified wages for the credit. So you can go to the next slide. So now we're going to layer in 267C, the constructive ownership rules, to determine who is actually considered a majority owner of a corporation, because it's likely broader than what appears on the surface. So according to 267C4, the family of an individual includes brothers and sisters, either whole or half, spouses, ancestors, meaning a parent or grandparent, lineal descendants, meaning a child or grandchild. And any of these relatives are attributed ownership from the majority owner. And they're also going to have a majority ownership in the corporation. So that further causes the direct majority owner to have a Section 152 D2 Cap A to H relationship to the individual that has the constructive majority ownership. And then that direct majority owner is considered a related individual for the purposes of the credit, and they would get kicked out. But let's say this another way. If the majority owner of a corporation has living ancestors, meaning parents, grandparents, if they have siblings or lineal descendants, meaning children or grandchildren, regardless of whether they're employed by the corporation, meaning these relatives merely have to exist, then the wages of the majority owner and their spouse, they don't qualify for the credit. And if they don't have these particular living relatives, then their wages do qualify. So we're going to walk you through some IRS examples in the notice so you have a clear understanding of the rules. So this first example in the notice is you have Corporation A, and they're owned 80% by individual E and 20% by individual F. And individual F is the child of E. So Corporation A is an eligible employer for the first calendar quarter of 2021. And both E and F are employees of A. So you can hit the slide button. So per the attribution rules of 267C, E and F are going to be treated as 100% owners of Corporation A. E has a relationship to individual F described in 152D to Cap C. That's because E is the father. And individual F has the relationship to individual E described in 152D2 Cap A. That's because individual F is the child of E. So in this case, click again, we have no wages paid to E or F would qualify for the credit because they're considered related individuals for purposes of the credit. So their wages are kicked out. So let's go to the second IRS example. So here you have Corporation B, owned 100% by individual G, and individual H is the child of G. So Corporation B, it's an eligible employer for the first calendar quarter of 2021. G is an employee of B, but H, the child, is not. So if you apply the attribution rules of 267C, the child, individual H, is attributed that 100% ownership of Corporation B. So both G and H are treated as 100% owners. And then you have G has a relationship to individual H described in 152D2C because G is the father of H. So in this case, with all that twisted ownership, you have the bottom line of none of G's wages are qualified because G is a related individual for purposes of the credit. So let's go to, we have two more examples to show you. In this case, you have C, Corporation C owned 100% by individual J. Corporation C is an eligible employer for the first calendar quarter of 2021. J, individual J is married to individual K. So they're married. They have no other family members. And that's for purposes of 267C4. So no other family members defined in 267C4. J and K are both employees of Corporation C. So per the attribution rules in 267C, K is attributed 100% ownership of Corporation A, and both J and K are treated as 100% owners. But because they don't have any of the relationships to each other described in 152D2A to H, their wages are considered qualified wages for the first calendar quarter of 2021. So in this case, they are qualified after you apply 267 and 152. Last example, you have Corporation D owned 34% by L, individual L, 33% by individual M, and 33% by individual N. So L, M, and N are siblings. And Corporation D is an eligible employer for the first calendar quarter of 2021. So individuals L, M, and N, they're employees of Corporation D. So now, if you look at through the attribution rules of section 267C, you get L, M, and N are treated as 100% owners. And then you have L, M, and N have the relationship to each other, they're siblings. So it's 152D2B you would look at. So they're siblings. And so the wages paid to them are not qualified wages for purposes of the credit. Now I'm going to kick it over to April to talk about our recovery startup business.
Right. Actually, I'm going to talk about just some of the other unanswered questions, but thank you, Chris, for walking us through those convoluted rules on ownership. I hope those examples helped. So here's a couple of other issues that were addressed in the notice. First, tips. We had been getting that question a lot, whether tips were included as qualified wages. And the answer for the notice is that cash tips that are over $20, which are treated as wages, reported as wages, basically, they're considered qualified wages if all the other requirements are met to treat the amounts as qualified wages. So not over the limit and that sort of thing. The notice also explains that these tips can be used to claim both the credit and both the employee retention credit, and the Section 45B tip tax credit on the same wages. So you don't have to pick and choose for that. So that was some information that the notice provided. Notice also clarified just for all of these determinations for the 2021 credit that the when you're determining whether it's an eligible employer, it is a quarter by quarter determination. So, and also that when you use the alternative quarter election for one quarter, that doesn't mean you have to use it consistently across all of the other quarters. So the notice, that was another thing that the notice made clear. Another clarification that the notice provided was on the issue of how to determine employees for the purposes of determining whether an employer is a large or small employer. And you'll know that that is important because it determines whether you can use all wages or whether you can use wages for employers who are not providing services. But the short answer to that question is what we had been saying, which what matters is full-time employees. The notice provides a definition of what's considered a full-time employee, and that is employees who worked during 2019. And a full-time employee is one who works at least 30 hours a week or 130 hours per month. So good news for the purposes of identifying qualified wages, that you can determine once you determine whether that you qualify, that doesn't mean only those employees' wages are determined can be determined to qualify for the credit. So you can use part-time workers' wages to qualify for the credit once you meet that determination. Okay. One more clarifying item. There was a question about, okay, so if I went back and filed an amended 941X for 2020, and I didn't do that until 2021, and you probably didn't because the legislation that allowed you to do that didn't happen until the end of the year. But if you got a PPP loan, so you went back and filed a 941X for 2020 quarter, you have already filed your 2020 tax return. If that has been filed, you will have to go back and amend that tax return, or consider for partnerships, you may have to consider the AAR requirement. But the salary expense reduction is tied to the quarter that the wages were incurred. So again, clarification on that. So this is our new news that we got just today. Again, it's Tuesday, August the 10th. They must have known we were recording today. They released this today, Revenue Procedure 2021-33, that answered another pressing question about whether COVID relief funds like PPP were to be included or excluded when you're trying to determine gross receipts. So I think this seems like great news, that these specifically as listed here, PPP, loan forgiveness under first or second draw, grants under Section 324, those are shuttered venue operating grants, as well as the restaurant revitalization grant. Those are all specifically excluded for the purpose of determining eligibility for the employee retention credit. So great news. And I'm, again, happy we were able to include this in this recording. Thanks again to our, I think our advocacy team has really done a great job trying to, trying to press for these answers. And this was one that was outstanding, and we're happy that they went ahead and answered that. Just quickly, the election to do this is made simply by excluding these amounts that are listed from gross receipts on the employment tax return. So it does say that the election has to be applied consistently across the quarters. And also, if you're considering first or second draws, you'd have to apply it consistently. And if you're considered a single employer for the purposes of aggregation rules, you would also have to apply it consistently. Now, Chris is going to talk about some of the changes that were made to the credit by the American Rescue Plan Act.
Sure. Thanks for that update on that is up to the minute news, April, that you just provided. Okay, so the American Rescue Plan Act, it made some enhancements to the credit. And one of those enhancements was to introduce the recovery startup business as a new category of eligible employer. So previously, an employer could qualify as an eligible employer in one of two ways, and that's by having a significant decline in gross receipts or a full or partial suspension of business operations. Now, instead, if an employer isn't considered eligible under those criteria, they actually can qualify under this third option as a recovery startup business. And how to qualify is they have to meet two criteria. They have to have started their business after February 15th of 2020, and the average annual gross receipts has to be $1 million or less. So if they meet these criteria, then they're considered a small employer, which is favorable because they can treat all employees' wages as qualified wages and not just those that are paid to employees not providing services. And the last point I want to make on this topic is that the credit for a recovery startup business, it can't exceed $50,000 for Q3 and Q4 of 2021. But if an employer is considered a recovery startup business and in Q3 and not Q4, they can still go ahead and get the whole $50,000 in Q3. But if they actually, if it works out better that they get more credit under one of the other significant decline in gross receipts or the full or partial suspension, by all means, they can choose that. So they now have three options. And now April's going to talk about severely financially distressed employers.
Great. And just one quick point on that gross receipts test. I did a little digging. So it says to calculate gross receipts test under 448C. And if you look at that, if entity is not in existence for the entire 3-year period, which is kind of your testing period, it applies for the period the entity is in existence. Because you might be thinking, how do I have 3 years if I'm, beginning after February 15th, 2020? So it's annualized. So you have to do an annualized method. So anyway, just I think we had some questions about that.
Yes, it was a little confusing the way it was written to say.
Yeah, very much.
3 prior years.
Yes. All right. So some quick information about another new term that was introduced in the American Rescue Plan Act is severely financially distressed employers. I can't say that fast, so maybe. So basically, these type of employers, they must already be eligible employers. So it's not a new category, but this is, so if they're considered severely financially distressed, this just means their gross receipts for the particular quarter are less than 10% as compared to the calendar quarter in 2019. So a 90% decline. If you're looking at how that works. So the benefit for these businesses is that even if they're considered a large employer, which, they would normally only be able to claim the credit for wages paid to employees not providing services, this category of employer can claim wages for all employees. So that's the benefit for those particular types of businesses. All right. And now Chris is going to talk about the kind of our guidance that we have on this credit so far.
And if you haven't noticed, there's a thunderstorm, of course, going on where I live. So some loud thunder. Some of it's been minor, but I'm sure you probably have heard something. So anyway, this slide, I use this as a cheat sheet for myself, actually. And then I put it in the presentations because I think it's a good go-to, and I just keep adding to it. It just shows the 3 pieces of legislation that either created or enhanced the credit. And then when we get guidance, we put that on there to show you where to go for each of the 3 pieces. So it's just a good little cheat sheet for you. So we're going to go to the next slide.
Oh, yes.
And now we're going to talk about what's next. Well, currently the infrastructure bill in Congress, it actually passed the Senate today, and today is August 10th. It does have a pay for provision in there that would end the credit early on September 30th. The credit is supposed to go through December 31st of 2021, but this bill, if it goes through the House and is signed into law, it would end the credit early on September 30th. So we are watching this closely, and we will let you know as we see things happening.
Okay, so I'm going to talk just briefly about, here's a link to some resources available related to the credit. We're updating this resource hub all the time. I also wanted to note that there's a Tax Section Odyssey podcast episode that provides pretty much the same material that's available in this recording. But as we get more information and as there's more information to share, that's a good place to highlight. And then I just wanted to remind everybody, be sure to join the Town Hall series on Thursday, August the 12th. There will be providing a legislative update and other important updates that you'll certainly want to know. Thank you so much, Chris, for joining me to discuss this very hot topic. We appreciate everybody's time and attention, and we hope that providing this video was helpful to give you the latest and greatest on the Employee Retention Credit. And the reason we did this recording is so we can have time to go through everything and not be rushed. So hopefully you can look at it, you can rewind it and play it again as what is helpful for you. We're certainly monitoring for further questions and further issues, and we'll be continuing to provide resources to help you on everything that's the latest on the credit. So again, thank you, Chris.
And thank you, April, for having me and presenting with me on this timely topic.
Yes. All right. I hope everybody takes care. Thank you so much.